Good morning, good afternoon, good evening, everyone who is listening to this video presentation. Welcome to my exposition for PhD Educational Management 604. My name is Wilwarn Analea V. Aligata, and I am tasked to exposit on the sources of finance for profit and nonprofit businesses. So these are my objectives. The first one is taken from the program of instruction that was provided for us by our professor, and that is to compare and contrast the sources of revenue of an institution. As an application, I would like that at the end of this presentation, you are able to use financial statements of a publicly listed company in the educational sector and identify the different sources of financing for that company. My references for this presentation, 6 of the book Financial Management for Decision Makers. I have also watched the YouTube video of Ken McElroy as an enhancement. So where do the rich store their wealth? And finally, as we will be using financial statements of a publicly listed educational company. And I have opted to choose Centro Escolar University, and shown on the screen are the links to their financial statements for the past year 2019. Now, to start with this discussion, we always ask, where is the money? So, or if you are wealthy, where do you store your money? Or if you want to have more money, where do you put or invest your money? So according to Ken McElroy, the rich store their money in these three sources, or in these three vehicles, but primarily on the one on the bottom. So natural resources. So according to him, the wealth of the rich, okay, lies in the land that they own, in the timber that they own, in gold, or anything that is from nature. So for example, oil, for example, minerals, and water can also be considered a natural resource. Now, the next way to store your money is to put it in businesses. And these businesses utilize the primary resources. Example of the utilization of water is the distribution of it. So you can go through, you can become rich, or you can put your money into that business by distributing water. For land, you can use it for farming, you can use it for, let's say, building an improvement and leasing that, or maybe even selling that improvement. Now, for tertiary or paper storage of wealth, he said that these are anything that is created by man, and these are based on the first two. So this includes cash, this includes ETFs, derivatives, the like. So now, if you want to look into that, so the source of that link is already provided in the slide. Where do the wealth of businesses come from? Source of cash, the source of wealth of businesses come from its activities. So primarily, there are three activities that a business engage in. So these are the operating activities, these are the financing activities, and then the investing activities. What are the operating activities? The operating activities are primarily those activities that the business is engaged in. For example, for Jollibee, this is in provision of food. So in providing for food, what are their activities? That also includes hiring of employees, choosing their suppliers. Okay, so those are parts of the activities of the business. But in each of these activities, in choosing your supplier, in hiring your men or your people, then it should be that you get the maximum or the optimal use of each and every activity. Now, for financing, this is primarily when the business seeks outside help for it to continue either its operating activities or its investing activities. So this is when the business seeks out loans or even issues bonds for it to raise capital. Investing, the last activity of a business, is when it also delves into other into activities that are not directly related to its operating, but it is very important. So what do I mean by this? A part of the investing activity of, let's say, Jollibee Foods Corporation can be the buying of land, the buying of a building for it to put up another branch. Okay, so that can be considered an investing activity of Jollibee Foods Corporation. So those are the three activities of the business. And as I have said, these activities of the business should be putting in, or should be injecting cash into the business. So all its operating activities must bring in an amount of money, and this can be seen in its statement of income or income statement. Financing activities, of course, if you go out for loan or you issue bonds, then in exchange for those, you get money. It can be seen in the balance sheet of the business. Okay, investing activities can also be seen from statement of cash flow. And of course, the balance sheet. Where did it put its money? Did it buy additional land? Did it buy additional building? Did it buy additional equipment? So that is all seen in the financial statements of the business. The different activities of the business, as I mentioned earlier, bring in sources of, or can be sources of money. So for the purpose of this discussion, there are two general sources of financing. So external sources and internal sources. And so external sources, it involves the decision of a party that is not a member of the business itself. So it involves a bank, it involves a financial institution, not just the business itself. An internal source of finance will be anything that can be within the purview or the decision of the directors of or owners of the business. These are the external sources of money, again, which involves other financial institutions. And internal sources, this row shows us sources of money that is within the purview of the business itself. Now, we also have two columns here. There is no one definition for what is long-term and what is short-term. But for Peter Attrell and for most authors, long-term is if it is at least 1 year. Short-term if it is less than a year. Whatever kind of combination that a business will look into, there is always this: the higher the risk, the higher the expected return from investors. We look into the first part, the external sources of money. So we start first with the long term. So there are 6 sources of financing for the long term. And then for the short term, there are 4. So ordinary or equity shares represents the capital of the business. So it is the backbone of the business financial structure. In a sense, this is when you turn your business into a pie, and then each slice of the pie has different people owning that part of the business. And that is called the share. Now, the owner who gets the pie also brings in money by buying that pie. So when they do buy that share of the business, okay, so if it is an ordinary or equity share, there is no fixed rate of dividend. So the dividend is part of the earnings of the business that is divided, or that is being returned back to its shareholders as part of their income. It really depends on how the directors of this business will decide. Now, ordinary shareholders only receive dividend if, so it is conditional. So if there is availability of earnings. So availability of earnings. So meaning the business earned something for that year. So if the business didn't earn anything from that year, then there is no sense of discussing the dividend and even the rate. Now, there is a sequence, an order as to who receives what part of the earnings. Let's go back to the income statement. The business is deriving income from the goods that it sold, the services it provided. So it is earning. From that earning is subtracted is the operational expenses. And then after the operational expenses, deducted next is the interest payments. Now, after the interest payments, of course, the government share is also deducted from it. Now, what is left that is now called the net profit? Now, if there is a net, the directors of the company will decide what part of the profit will be returned back to its shareholders as dividends and what part of the profit will be retained, which is now called retained earnings. So the dividends is only being given out to make the shareholders a little bit happy parts of the time. But again, in talking about dividends, there is no fixed rate. Now, there is a high, for this last bullet point, there is a high rate of return expected. Okay, so as I've explained earlier, your 3 cents can now become 10 pesos, can now become 100 pesos. Okay, either way, if the business gives back all its earnings, okay, as dividends, then you get a return. If ever it retains its earnings, then it is usually to increase its capital base or share capital by getting more assets, okay, getting more equipment for the business to expand. And in doing so, okay, the value of your share becomes higher and higher. Okay, and this is why it is called there is a high rate of return expected. Okay, so that is ordinary or equity shares. So for preference shares, it also forms part of the share capital of the business. So it is also the backbone of the business's financial structure. What makes preference share different from the ordinary share is its fixed rate of dividend. Ordinary shareholders will get depends on the decision of the board on what part of the retained earnings will be returned back to its shareholders and at what rate. But for the preference shares, this is also already fixed. So there is a fixed rate of dividend. Regardless of how much earnings of the company identified for giving back to the shareholders, the fixed rate of the dividend per share is already identified at the start of the corporation. Usually this is identified in the articles of incorporation. Now, the preference shareholders receive dividend first, okay, after other investors. So suppliers, lenders, and then that's the only time when preference shareholders come in. So if the business is wound up also, that is also the hierarchy of getting your share of the business. So preference versus ordinary, so whatever they get, whatever each one is entitled to, their rights and privileges, these are specified in the articles of incorporation. So for preference shares, since the fixed rate of dividend is already identified, there is a limited rate of return. So it is also lower compared to ordinary shares. So the first two are sources of capital, okay, of share capital. So if you issue preference shares or ordinary shares, what does the company get of it? Why is it a source of income? Because if more people invest in you, okay, as shareholders, that will be an injection of money into the business. Okay, so that is a source of financing. So the second part of this discussion involves with the financing activities of the business. So this includes borrowings. But this is primarily used to amp up the capital of the business. So it is called loan capital. Previously, the first two are share capital. This one is for loan capital. But it can also be used to finance operations. But if that will be the case, that will only mean the business is not doing well because it cannot even finance its own operations. Assuming that it is okay, so whether for loan capital or finance operations, when the business decides to go on this external source of financing, they sign a contract. This contract indicates the coupon rate or the interest rate, how much is being charged for the principal being borrowed, what are the dates of interest payments, so when are you going to pay interest, what are the capital repayments, how much are the capital repayments, and the dates, of course. Why are these different, the interest payments and then the capital repayments? So an example of this is when you borrow money from the bank to build a certain, for example, a certain building. When the building is just being built, okay, you are not required by the financing institution to pay already the capital because the building is not earning yet. Okay, so you just pay the interest payments. Okay, so it depends whether on a monthly or quarterly basis. When the building is already finished and it is already out in the market, you are already utilizing this building, okay, that is only the time when you are required to pay capital. For other loans, this may no longer be different. So for example, for us individuals, when we borrow from a financial institution, usually we pay both the interest and the capital payment. So maybe in the first year, all of it is interest and then a little of capital. Okay, so like when you acquire a condo property, which is already there for you to be used right away. Maybe on the 5th year, that's the only time when you see your capital repayments being higher than the interest payments being paid. So that is the difference between interest payments and capital repayments. And the last one being identified and necessary to be identified in a contract is the security for the loan. So usually lending or financial institutions require this from you, especially if it's a very, very large amount. And usually the property that you wanted to acquire through this loan is the one that is being used as security. So, but generally speaking, assets used to secure the loan normally are non-perishable, easy to sell, and of high value relative to their size. Okay, so the security, so more popularly known as collateral here in the Philippines, are usually charged a fixed charge or a floating charge. The example that I mentioned earlier is a fixed charge because you have a particular or a specific asset that has been identified as security for your loan. Now, floating charge is usually done for businesses kasi nga, it is primarily not to finance operations, but to increase capital. So that's why it is called loan capital. And so in doing that, the lending or the financial institution usually just gives a floating charge over the whole of the business's assets. But in the event of default, the floating charge becomes a fixed charge. If it comes to that, the lender may seize and sell the property to cover the loan. Aside from the contract, okay, there is also called the loan covenant. What is a loan covenant? So the loan covenant is, these are the terms and conditions that are being added into the contract when you borrow something. So particularly, these are obligations or restrictions on the businesses that form part of the loan contract. So what are they? So this may be the right of lenders to receive regular financial reports concerning the business. Now, sometimes or often, this is not, when we say, oh, why do they need financial reports? Well, this is because not all businesses are publicly listed. And that also means that if you're not publicly listed, your financial statements are not publicly available. So your lenders might put this into writing that you need to provide them quarterly and annual financial reports for them to be assured that your business is indeed doing well. And if you did borrow to increase your assets, okay, to expand the business, they will know if it is really doing what it is supposed to do. As part of the covenant, it can be that there is an obligation to ensure the assets being offered as security. So, for example, if you have to borrow for a car loan, there is an obligation for you to insure the car. So it is comprehensive insurance, such that whatever happens to the car, it can be replaced. It can be paid in full by that insurance company. Another imposition may be a restriction on the right to issue further loan capital without prior permission to the existing lenders. If you have already taken out a loan, it can be that you also took out another loan from another financial institution, and you have also put up the same property or your entire business as collateral. So that will be a source or an issue later on if your business fails. And who will now get paid first? Is it the one that you have asked for a loan first? This can be done by the financial institution. Okay, and then the next, a restriction on the right to sell certain assets held. So if you go for borrowings, it may be that you will not be allowed to sell any of your existing property without the knowledge and the approval of the lending institution. And then also a restriction on dividend payments or payments made to director. And of course, they may impose minimum levels of liquidity and or maximum levels of gearing. So for example, in my place of work, we need, for financial liquidity, we cannot loan our entire salary to zero. By the end of the month, you still have 15,000 as take-home pay. So that is for the individual. But for the business, it can also be that there may be an imposition that you should be earning or you should maintain this level of income. This loan is outstanding. So that is part of the covenant. This is the risk axis, and then this is the return axis. And then shown here in this quadrant are the three. So we have the share capital, the two here, and then the loan capital. So we can see here that the share capital has higher risk from an investor's perspective, but it also has a higher return. The least is the loan capital. But for the business perspective, or for the one who receives this, it is the inverse. So the loan capital has the highest risk. It really depends on what your risk appetite is. So if you know that you can pay, then this is the way to go, okay? But if you don't want to pay and it doesn't bother you if you have more shareholders, more voice in the decision making, then raising capital as shares by issuing shares is the way to go. So these are also provided by Peter Attrill when deciding between preference or share capital or loan capital as a means of raising new finance. So which one? Now, is loan really that important? So why not just raise capital by issuing shares always? So is Warren Buffett's view of debt. So here, it is life and death. So whether they take on loans or not, based on this reputation, it really doesn't matter for as long as they have that reputation, and when they exercise the option to get into loan, that is okay. Okay, so yeah, it really doesn't matter. But if you lose that reputation, maybe there is a very limited way for you to inject more money into your business. It's either you just have to go to the two other sources of income, so your operations activities, and then investing activities. Okay. Now, these are the other forms of borrowing. So I will not go through this in any detail, as this will be discussed in another module. The next part of this exposition is the finance lease. So finance leases are done when, instead of buying an asset, a business may arrange for a bank or other business to buy it and then lease it to the business. So the legal ownership of that asset that was bought remains with the lessor. But with the lease arrangement, all the rewards and risk associated with the item being used is unto the lessee. So here, the lease agreement covers a substantial part of the life of the leased items and cannot be canceled. So what's the advantage? So you're paying for something, but it's not yours. So, but you can use it. So what are the advantages? So it eases borrowing. Why? Because you are not actually buying something. You are not, unlike the other one, you are tied to that property, just borrowing, hiring that property. As to the cost, so for example, you have 1.5 million cash that you want to invest in a laundry business. So you have that money. Now you bought already the equipment that you used for that money. Now, as you expanded your business, you needed now this time, let's say a pickup, a vehicle that can load lots of laundry into the vehicle. So for example, you are now servicing a hotel or a transient house. Okay, so every week you are going to collect this amount of laundry, then have it washed, and then you have to bring it back to that. Your finances are no longer enough to buy a truck or to buy a van. So how do you go about getting a van or getting a truck without shelling out all of the rest of your money? Option. You ask another business to buy it for you for your exclusive use. Okay, so it's not yours, but you can use it. This is what is happening in our place. It's a mining town. The primary business is mining gold, but they have outsourced. A lot of services. So they just want, oh, these are the vehicles that we want. We want a pickup truck. We want an SUV like this, okay? Or we want vehicles with these capabilities, okay? And then someone else will provide it for them. So it is somehow servicing. So they are being serviced in this manner. So they are able to use that vehicle without the problem of ownership. Ownership remains with the lessor. So the lessor, he is the one that maintains the sasakyan. He is the one that pays for the insurance. He is the one that keeps it in good running condition. In that leasing agreement, so you have lessened your costs. And of course, that made you more flexible in using whatever money that you have in your bulsa. Okay, and that also has improved your cash flow. So you can use all your other money into activities that are really essential to your business. Okay, so now an example of finance lease is the sale and leaseback arrangements. So this is when a business raises finance by selling an asset to a financial institution. And then the sale is accompanied by an agreement to lease the asset back to the business to allow it to continue to use the asset. So you own that building, you own that land. Going through fire insurance, mortgage insurance, paying taxes, blah, 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 okay, is not your thing. And then you don't want to commit people of your business, okay, your small business, to do that for you, okay? So you just want whatever is necessary. You just want to run a hotel. You wanted to sell that property to a financial institution, maybe a financial or another business. And but with the sale, with the contract of sale or the deed of sale even, there is a term and condition there that should this sale progress, you are going, or that new owner will renting it out, that building or that a specific space for you to use exclusively, maybe for a period of 10 years, subject to review. With it, yes, you do have that asset, you do have that wealth. However, you have no money. Your hotel is already outdated. You need to make it more chic. You need to make it more bright. You don't want anymore the country vibe of your hotel. You want it to become more modern in look. And so you have to, let's say, redecorate. But you don't have money. So maybe a sale and leaseback agreement or arrangement can work for you. Okay, so if you sell your hotel, that land and then the building, it is now owned by a different person or a different business entity. It will now be off your, it will no longer be part of your balance sheet, that hotel and land. But in exchange for that, you have your cash. In addition, your lease rental payment can be included in your operations expense. So in your income statement, whatever you pay to the new owner, it will now become a lease rental, and it can be subtracted from your income statement. And because of that, it can be a great benefit to you as regards taxation purposes. Now, in the Philippines, who does sale and leaseback? So I've looked into it, and DBP Leasing Corporation is doing this. So the next is hire purchase agreements. You are cash strapped, you need additional capital, you need additional vehicle, you need additional equipment, but you don't want or you don't have money to acquire that equipment, new vehicle, new asset. Okay, so what do you do? An option for you will be hire purchase. Okay, so how different is hire purchase from lease agreements? Okay, so hire purchase, at the end of a certain period, the legal ownership of that asset will become yours. So it is a form of credit to acquire an asset. So a customer pays for an asset by installments over an agreed period of time. So you just pay down payment and then installment at regular intervals, and then after a certain period of time, you will now become owner of that property. So shown on the right is the hire purchase process. How you do, what is being done with car loans. Okay, so Toyota, Hyundai, Ford, okay, will supply the car to you. Okay, the bank, okay, BDO, BPI, whoever, okay, pays, okay, that supplier in your behalf. And then the transaction now is between the two of you. So you pay the initial deposit and then you pay regular payments made over time. Then after you complete those payments, and then the ownership of that property now belongs to you. Okay, so that is now your hire purchase. Okay, securitization of assets. What are securitization of assets? So here we have a bundling together of illiquid. This means illiquid assets means not easily turned into cash. So what are these? What are an example of this? So let's say you have a power plant. Okay, that is an asset, right? So you own the land, okay, you own the equipment in that land, but you cannot easily sell a power plant. Okay, so in that sense, it is an illiquid financial asset. Okay, now if this happens, securitization of assets is you bundle together these illiquid assets. So all power plants located in the country, you securitize this. Okay, and then you put it in a what? SPV, a special purpose vehicle. Okay, wherein this will now be issuing. Okay, be issuing bonds. Okay, bonds or notes, so that, okay, whoever buys their notes, their bonds, okay, will be part owners, okay, will become part owners of that bundle of property. Okay, so and then that that will give now to the that will now give cash to back to the business if you need this kind of securitization. So uh, an illiquid asset, but an asset just the same. So that will raise money for you. Okay, so that is securitization of assets. Your mutual fund manager will what? Pool those resources. You will be, if the real assets market is increasing at this time, so you are buying, okay, assets in this manner as an investor. But as for the business, they are being financed in this manner when mutual funds that are investing in real estate properties. So that can be an example for securitization of assets. Onwards, okay, we will be discussing short-term sources of external financing. So the first part is bank overdrafts. What are bank overdrafts? So this enables a business to maintain a negative balance on its bank account. So flexible form of borrowing, as the size of the overdraft can, subject to bank approval, can be increased or decreased more or less simultaneously or instantaneously. So repayable on demand. So an example of this is checking accounts. So when you open a checking account, you of course can only issue checks based on how much is in your checking account, especially when it is dated to a specific date. During that day, okay, your account should have that specific amount. Okay, otherwise, what we know as tumalbog na cheque will happen to you. Okay, so the US, this is an example of nag-negative yung balance mo. Is bills of exchange. So this is similar to an IOU. Okay, bills of exchange, basically these are parang promissory notes that you write. Okay, that you write your name, O, whoever, Mr. or whatever, whoever you own specific amounts of money in, and then you promise to pay, okay, with this amount by this date. Okay, so these bills of exchange is usually 0% interest. Okay, kasi nga you have already identified how much you are going to pay this person at this specific date. So this is usually done, okay, between buyer and supplier. Okay, this is used by a buyer to a seller in exchange of goods. Supplier keeps the bill until the date of payment. So it is short term because it's just between 60 to 180 days. So the bank will often be prepared to pay the supplier the face value of the bill less a discount, and will then collect the full amount of the bill from the buyer at a specified payment date. Now, this is rarely used nowadays. Debt factoring, okay, debt factoring. So this service is offered by a financial institution, and this time this financial institution has a specific name, a factor. So who is the factor? The factor takes over the trade receivables collection for a business. So the undertaking credit investigations and advice on the creditworthiness of customers is being done by them, and it offers protection for approved credit sales. So examples of factors are credit cards, so Visa and MasterCard. Okay, now there are two main forms of factoring. So recourse factoring, okay, or non-recourse factoring. So for in the first portion, the recourse factoring, the factor assumes no responsibility for bad debts arising from credit sales. I didn't vouch for that person, so I'm not responsible for that debt. Okay, yung non-recourse factoring, for an additional fee, the factor assumes responsibility for bad debts up to an agreed amount. So, for example, nagkaskas ka ng nagkaskas sa credit card mo, pero hindi mo na siya binabayaran. Okay? So, here, the factor pays whoever, yung company na yon, they assume responsibility for the debt, but it will also charge you a certain amount. Kaya every time that you carry a balance in your credit card, then that debt is increasing or ballooning. Okay, what is the advantages of that factoring for a business? Okay, so they incur savings in credit management. The factor assures payment of whatever is owed to the company. And because of that, there is more cash flowing into the organization or the business. They will not allow people from their company to what? To solely manage debt. Okay? So they have outsourced this to another company. And of course, again, as I mentioned earlier, it creates more productive time for key personnel. Okay, so this is the example of external source of financing, particularly the factoring process. This is the client business. Okay, this is your customer. You supply goods on credit to that customer. Okay, so hindi siya kaagad nagbayad. Now, you will be, so you just, that is your only transaction with your customer. Now, the rest of the time, you are going to deal with the factor. So the factor pays 80% to the client immediately, okay? And then later on, it pays 20% of the balance, okay? So when the customer pays the factor itself. The next source of short-term financing, external, is invoice discounting. So what happens in invoice discounting? This involves a factor, again, and other financial institution that provides a loan based on a proportion of the face value of a business's credit sales outstanding. So for example, your business is, you allow payments to your business through credit card. This means that you didn't receive money immediately for the goods or the services that you have sold. Okay? So, ibig sabihin, meron ka pang mga sisingilin or meron ka pang ina-expect na magbabayad sa'yo. 1,000 worth of stocks ko is na ilabas na lahat. Now, because of that, you can use this as security. Kasi, oy, wala pa, hindi pa kasi ako binayaran. For example, Lazada. So, Lazada allows cash on delivery or cash on pickup. Okay? It may be that at the end of the month, let's say, hindi ka agad niya na-receive yung pera. Maybe because LBC or its delivery partner in Japan is not delivering at that time. So, in their books, many of the items were already sold, but these items were not yet paid for. But you need to, let's say, Lazada needs to restock. Kailangan niya ng stock to maintain levels of supply. So, let's say kulang siya ng pera. So, what will Lazada do? It can make utang from a bank, let's say, or another factor, and say, pautang naman, meron naman akong ina-expect na 500,000 na mga bayarin. So it can loan Lazada as much as 400,000 for Lazada to have more cash to buy more or to have more in its inventory. Now, how long will Lazada be able to pay? So it depends really on their credit rating, but usually for invoice discounting, this is 60 to 90 days. So collecting trade receivables outstanding remains with the business. It is still the responsibility of Lazada to collect, and repayment of the advance is not dependent on the trade receivables being collected. Okay, so yun pa rin. Sila pa rin magbabayad. Now, what is the advantages to this? Confidential form of financing. So we, the customers, will know nothing about the utang of Lazada. Okay, so we don't know how much Lazada is making utang for it to maintain certain levels of inventory. The service charge for invoice discounting is only about 0.2 to 0.3% of sales revenue compared with 2 to 3% for factoring. If you do debt factoring, katulad ng kanina, okay, wherein the debt factor, the bank will be the one to make sale in behalf of the supplier, then it may damage the relationship within the business and its customer. Okay? It's just, sa example ko, it's just Lazada and whoever that nagpautang sa kanya who knows about the utang. And kung sino man yun, hindi niya hahabulin yung mga customer ng Lazada. Okay? So that is invoice discounting. What should you consider when you borrow long-term or short-term? So things to consider, there are 4: matching, flexibility, refunding risk, interest rates. So matching, ano ba yung matching? So what kind of borrowing are you going to do and the nature of the assets held? Yung Lazada, wala naman siyang ibang asset, I think. Wala siyang ibang asset. Maliban siguro sa warehouse. Ang assets lang siguro ng Lazada is yung inventory levels na meron siya. But for now, maybe at this time of this discussion, what Lazada can do, or the best utang that it can do to the best of its advantage is yun nga, invoice discounting. If you do long-term financing also, you have to finance assets that form part of the permanent operating base of the business. So for example, Lazada really wants to go on borrowing, okay? Long-term borrowing. It should be for Lazada to acquire a warehouse. Pang-replenish lang naman ng stocks, again, yun yung example natin, invoice discounting. Okay? Kung marami pa talaga siyang outstanding na hindi nasisingil kasi nga COVID ngayon, mabagal yung delivery. Okay? So, mas humaba yung time niya para makapaningil and maibalik sa kanya yung pera. Okay? Now, flexibility. So again, flexibility, long-term, short-term. Okay? So it really depends on your commitment. So the interests are high, okay, for long-term. But also, kung short-term naman yung kinuha mo, pero lagi mo namang renew, then baka mas tumataas yung other fees mo. Okay? And then, prepayment of short-term borrowing may have no penalty. Ay, 3 months sana mo siya, pero nabayaran mo kaagad-agad siya. Like after 1 month, nabayaran mo kaagad. So that has no penalty. Yung mga sasakyan, pag 5 years mo talaga siyang babayaran. Kasi mapapamahal ka kung ipi-prepay mo siya. Let's say 4 years na lang or 3 years na lang. Kasi ayaw mong magbayad ng matagal. So meron siyang penalty. It really depends on you. Whether on these considerations, matching, flexibility, refunding risk, and interest rates, whether you go for long-term or short-term loans.